Hi everyone, I am Kat and I will share to you a detailed breakdown of credit card processing and underwriting for businesses, including the filling out of a merchant's processing agreement form. Okay, so let us start. Businesses rely on credit card processing to accept payments from customers and on business credit cards to manage their own finances. Both processes require thorough evaluation, known as the underwriting, to assess the risk and ensure compliance. In this guide, we will explore the detailed steps of credit card processing, the underwriting process, and the associated fees involved. We will provide examples and scenarios to illustrate how these processes work in real business context. Credit card processing for businesses. Credit card processing enables businesses to accept payments from customers using credit and debit cards. To set this up, a business must partner with a payment processor, open a merchant account, and understand the transaction fees involved. Who are the key parties involved in credit card processing? First is the business owner or the merchant, customer or the card holder, acquiring bank or the merchant's bank, issuing bank or the customer's bank, payment processor, credit card networks like Visa and MasterCard. Business owner or the merchant provides goods or services and accepts credit card payments. Customer or the card holder is the individual or company purchasing the goods or services using a credit card. Acquiring bank or the merchant's bank is the bank or financial institution that handles credit card transactions for the merchant. It accepts funds on the merchant's behalf. Issuing bank or the customer's bank is the bank that issued the customer's credit card. It transfers funds to the acquiring bank after verifying the cardholder's transaction. Payment processor is a third-party company that facilitates communication between the merchant, acquiring bank, and the issuing bank. And credit card network like Visa and MasterCard are networks that provide the platform that processes the transaction. How credit card processing works. Here is a step-by-step example. For example, we have a scenario wherein a retail clothing store accepting a $200 payment. For step 1, payment authorization. A customer uses their Visa credit card to purchase a suit for $200. The merchant enters the transaction into their POS system. Then the payment processor forwards the payment request to the issuing bank or the customer's bank through the Visa network. Then step 2, transaction authentication. The issuing bank checks the customer's account to verify they have enough credit available and confirms the payment details. Step 3, transaction approval. The issuing bank approves the transaction and an approval message is sent back to the merchant. And step 4, payment settlement. The $200 transaction amount is transferred from the issuing bank to the merchant's bank account, typically within 1 to 3 business days. The merchant receives the payment minus the processing fees. Now, here are the fees associated with credit card processing. The fees for processing credit card payment are a combination of several charges. Let's break down the fees involved in the $200 transaction from the scenario above. Number 1 is the transaction fees. These fees typically range from 1.5% to 3.5% of the transaction amount. For example, interchange fees paid to the issuing bank typically 1 to 2%. For a $200 transaction, the interchange fee might be $3. Then assessment fees paid to the credit card network like Visa and MasterCard, generally 0.1 to 0.3%. For a $200 transaction, the assessment fee might be $0.4. or $40. And for the processor fee charged by the payment processor, typically around 0.2 to 1%. This could be $1.50 for the transaction. Total transaction fee example for the $200 payment, if the total fees add up to 2.45%, the business would pay $4.90 in fees, leaving the business with $195.10. Number two is the monthly fees. Processors may charge a monthly service fee ranging from $10 to $50. For example, if a business has a $30 monthly fee, this would be an additional cost they need to budget for. Number three is the chargeback fee. If a customer disputes a charge and the business loses the dispute, they may face a chargeback fee of $15 to $100. For instance, if the clothing store has a chargeback dispute and is charged $35, they only they not only lose the original $200 sale but also incur an additional fee. Number four is the PCI compliance fee. To ensure security and compliance with payment data protection standards, businesses may be charged a PCI compliance fee. This fee ranges from $50 to $200 annually. For example, if the store pays $150 per year, this is another expense linked to maintaining credit card processing. Underwriting for credit card processing accounts. In credit card processing, underwriting refers to the process through which a financial institution or payment processor assesses the risk of approving a business or merchant to accept credit card processing or payments. This evaluation is critical to determine whether a merchant can handle the potential financial risks involved in processing transactions, such as chargebacks, fraud, or default. Before a business can accept credit card payments, the payment processor and acquiring bank evaluate the risk involved. This underwriting process assesses various factors to determine whether the business qualifies for a merchant account. Key factors considered in underwriting. Number one is the business type and industry. Some industries, such as travel, adult entertainment, or subscription services, are deemed high risk due to higher rates of fraud and chargebacks. For the example scenario, a travel agency who processes a high volume of transactions that are prone to cancellations or chargebacks, meaning their transaction fees might be higher, closer to 3.5% per transaction compared to a grocery store that may pay 2% only. Number two is the business financials. Payment processors evaluate the annual revenue profit margins and cash flow of the business. Businesses with stable financials are considered low risk. Example, a business that generates $500,000 in annual revenue with a healthy profit margin is considered a safer bet than a startup with inconsistent cash flow. Number three is time in business. Most is, more established businesses face less scrutiny compared to startups. A business with at least 2 to 3 years of history is seen as more reliable. See, for example, a 5-year-old retail store is viewed as less risky than a 6-month-old startup, which could lead to higher fees for the startup or even a denial of a merchant account. And number four is the transaction volume. The business's expected transaction volume impacts underwriting. A business projecting $50,000 in monthly sales is easier to underwrite than one projecting $500,000 because of the risk involved with handling larger amounts. When a business applies for a credit card payment processing services, lenders assess the business expected transaction volume to determine the level of risk involved in handling payments. For example scenario, Business A, a lower transaction volume. Business A is a small e-commerce store that sells customized t-shirts online. They expect to process $50,000 in monthly sales based on their projected volume. Because their transaction volume is moderate, the risk is lower. If any issues arise, like chargebacks or disputes, they are easier to manage at this volume. Lenders or processors may offer more favorable terms such as lower processing fees like 2.5% per transaction, lower reserve requirements, the amount withheld by the processor as a safeguard, and faster funding times. Funds are released to the business within 1 to 2 days. And number five is the owner's credit score. If the business is relatively new or lacks credit history, the owner's personal credit score is used to assess the risk. A strong credit score ranging 700 plus or 700 and above can lead to favorable terms, while a lower score below 600 may result in higher fees or a denial of the merchant account. For example, owner with a strong credit score, 700 and above. Owner A has a personal credit score of 720. They run a small software development company that has been in operation for 6 months. Even though the business itself is new and has little credit history, the owner's strong credit score gives confidence to lenders. The owner has a solid history of paying bills on time and managing debts well. As a result, the lender might approve the application quickly, offer a lower interest rate such as 14% annual percentage rate or APR, provide a higher credit limit like $50,000 because the lender trusts the owner to manage larger credit lines responsibly. For the second scenario, owner with poor credit score or below 600. Owner B has a personal credit score of 560. They also run a new business, but due to past financial struggles, their credit score is low. The low credit score signals to lenders that there's a higher risk of late payments or defaults. As a result, the lender may offer a higher interest rate such as 25% APR. Approve the application with a lower credit limit into $10,000. Add additional fees such as an annual fee of $99 or more. In some cases, the lender might deny the application altogether or require the owner to provide additional collateral, such as personal guarantees. Understanding the credit card processing and underwriting processes is essential for businesses looking to accept payments and manage expenses effectively. By thoroughly evaluating the fees involved and preparing strong financial documentation, businesses can improve their chances of securing favorable terms from both payment processors and credit card issuers. Managing credit responsibly and maintaining a strong credit profile will enable businesses to access the financial tools they need to grow and succeed. Now, here is the complete guide to filling out a business credit card application form. Applying for a business card or credit card involves several steps, and ensuring accurate information is crucial to avoid delays or rejections. Below is the comprehensive guide, or here are the comprehensive guides on how to properly fill out a business credit card application. We will break down each section of a typical form, provide examples, and explain what lenders are looking for in each section. Understanding the purpose of the form. Business credit card applications allow lenders to evaluate both the business and the business owners. The form collects detailed information about the company's finances, credit history, and the personal financial situation of the owner, especially if the business lacks its own established credit.